So thank you all of you that still have the energy to stay here and to hear to the conference. Now we are entering into a, let's say, more technical issue, but also very crucial issue that has been already mentioned in the previous panel, which is how to finance all these massive investment needs that we have in Europe, and particularly how to move towards this European Savings and Investment Union. We will start with an opening video that has been recorded by the director of the European Stability Mechanism, Pierre, who will give us some opening notes, and then I will pass the floor to our panelists.
Ladies and gentlemen, good morning from Luxembourg. I truly wish I could be with you in Paris today. Unfortunately, prior commitments prevented me from joining you in person. Yet I'm glad to be able to contribute to this important conference. Next year marks the 10th anniversary of the launch of the Capital Markets Union. Its necessity was recognized a long time ago, but progress has been incremental. We are still a long way from achieving the ultimate goal, a fully integrated capital market. I am hopeful that the political capital invested by Pascal Donoghue in this project and the Eurogroup statement that came with last March will help generate the necessary momentum to make significant headway. Because here, time is of the essence. With Europe facing slow economic growth, the need to advance the Capital Markets Union, or the Savings and Investment Union as it is now often being referred to, has become more critical than ever. Over the past years, growth in the EU has remained under the 1% mark. While it is expected to increase in the short term, it remains shallow. Against the backdrop of current geopolitical fragmentation, geostrategic tensions, and a potential introduction of tariffs by the incoming US administration, Europe is particularly vulnerable. For the EU, total trade represents 60% of GDP. For the US, this number is about 25%. For China, about 35%. So Europe has a lot more to lose over trade wars. I'm deeply convinced that Europe needs to continue promoting multilateralism. But Enrico Letta's report also highlighted that Europe should leverage on what it can control itself, and that is the single market. Although it is part of the great European successes, alongside the introduction of the euro and the Schengen Area Agreement, it remains fragmented. It needs to be deepened and updated. It would help boost European productivity, which is at the core of European growth. A recent IMF analysis suggests that completing the single market could substantially boost the EU's economic performance. Reducing remaining barriers for goods and services by 10% could increase output by up to 7 percentage points over the long run. As indicated by Enrico Letta, part of the solution is to boost innovation. Compared to the US, innovation has been lagging behind in Europe. The innovation gap has been driving the productivity gap. Over the past decade, European companies have invested way less in research and development than US firms. This shortfall limits Europe's capacity to innovate and use new technologies. An integrated market for capital across the EU is indispensable to generate the necessary resources and provide sufficient access for companies to funding through venture capital, equity, and bond markets. This is particularly key for startups and high-growth firms that rely on risk capital to develop innovative technologies. It would also allow for a better allocation of capital across the EU. As noted again by the excellent Letta report, massive household savings are available. They only need to be channeled to the right opportunities without facing multiple internal barriers, and there are a lot. An integrated capital market would also attract new investors. During some of our roadshows that we do here at the ESM, We have heard from investors that investing in the EU can be cumbersome and costly. In the US, they invest in one market, in one risk. They do not need 27 legal experts to analyze 27 different markets. There is a clear need to harmonize regulation across member states. Looking at the broader picture, private sector financing will play an essential role in financing Europe's ambitions like the green and digital transitions and security needs. According to Mario Draghi's report, an additional 750 to 800 billion euro are necessary per year to overcome the coming years. The lion's share is expected to come from the private sector, and the Savings and Investment Union will be necessary to mobilize this money. The remaining amount will need to come from public resources. Some of these resources will need to stem from domestic purses. This might be challenging, as the pandemic crisis has led to a sharp increase in public debt. Many countries will have to consolidate their public finances under the new fiscal framework. Consequently, there have been calls to use more public money at the European level. The European Commission, the European Investment Bank, and the European Stability Mechanism issue safe assets. In March this year, the total amount of safe assets issued by these institutions reached the 1 trillion euro mark. The ESM's maximum lending capacity is 500 billion. Its current lending capacity is 422 billion euro. In his report, Enrico Letta suggests that the ESM provide precautionary credit lines to its members, the 20 countries of the euro area, to help them finance their defense and security expenditures. With a war at our doorstep and the US's potential disengagement from NATO ramping up, such expenditures becomes ever more important. The ESM is ready to work on this with its member states. Ladies and gentlemen, Heraclitus said that big results require big ambitions. The ambitions have been laid out. They are necessary for Europe to thrive. But to achieve them, we need the necessary means. The Savings and Investments Union will be central in this endeavor if we want to be successful. Public institutions like the ESM also play an important role in this. Ultimately, it is political will and political alignment that can make it happen. I can assure you that I do not miss any opportunity while in the Eurogroup to push for more European integration, because what we need in these times is more Europe, not less. Thank you very much.
Thank you very much. So I think Mr. Gramegna has set the scene very clear, and let me summarize this in 3 points that are in the Draghi and the Letta report. First, we have massive investments needs. This is the 700 billion annual investment of Draghi report. Second, public investment public budgets are under strain, so we cannot cover all these investments only through public investment. We have to mobilize private investments, private markets. And third, we have excess saving in Europe, and we are not able to channel our savings to finance our investment needs. So now I will pass the floor to the 3 panelists. Let me, first of all, introduce them. I will start with Marianne Barbat-Layani. She is the president of the French Financial Market Authority, Autorité de Marché Financier. Then I will pass the floor to Mrs. Verena Rose. She's the president of the European Securities and Markets Authority. And in the end, I will pass the floor to my colleague, Johannes, who's the external, let's say, expert, co-director of our sister institution, the Jacques Delors Center of Berlin. So first, the floor is yours.
Thank you very much. Well, obviously, you might hear a little bit of the same between Verena and myself, because the French market regulator, Autorité des Marchés Financiers, is a member of ESMA. And by the way, on the subject we are discussing today, which is used to be called Capital Market Union and is now Savings and Investment Union, ESMA has produced a report in the spring, if I'm not mistaken, so probably Verena will cover this. But I just wanted to mention that IMF is a member of ESMA. So let me just give a few words of introduction and then maybe focus on the proposals. First of all, I consider that our job as financial specialists is to make sure that the EU has the means to finance its political objectives, which is what we have heard about, by the way, in the previous roundtable. We heard that there is a strong link between what will be achieved in terms of energy transition and democracy. Obviously, we are not in charge with democracy, but we are in charge with helping to find the ways to finance the energy transition and other major political objectives. And that is one of the reasons why the Capital Market Union project has been relaunched. The second point, I'll be short, but maybe a quick word of history. Capital Market Union, as it was said, was launched 10 years ago. It was launched under a very different context by a commissioner in the EU who was a British gentleman, Sir John Hill. And the origin of the project is that he realized that the mix of financing was very different in the EU and in the US. It was said before, the financing of the economy in the EU massively relies on banks and bank financing, while in the US it's more on market financing. That is not a criticism in itself, but the fact that markets were underdeveloped in the EU was already something that the European Commission had in mind and thought that could move towards a different mix of financing. That was the origin of the project. We don't have much time, but a lot has been achieved, but clearly we are not quite there yet, and we don't have an integrated financial market in the EU, and that is the reason why the project is needed. Why it is more needed now and differently needed? Well, it's been said also. We need more money, and that is not a small amount of money that is needed. It's 800 billion euros yearly to finance the energy transition, the digital transition, but also finance our defense industry, which is obviously a subject that we all have in mind in the current context. So why could it work and why should it work now? It could work because the money is there. The only problem is that we don't have the right ways to give an orientation to the savings that are at a very high level in the EU, which is not the case in other large jurisdictions. So we have savings. The only problem is that it does not stay in Europe, or not stay enough in Europe, or it doesn't go in the right places in Europe, and that is one of the objectives, to have a better oriented European savings. The cost of a non-integrated financial market is very high. We have seen since the launch of Capital Market Union a wider and wider gap in terms of economic development, growth, productivity, you name it, between the EU and the US. I'm not saying the only reason is that the mix of financing is different, but the underdevelopment of an under-integration of EU capital markets is certainly one of the factors. So why could it work now and what to do? Why it could work is that there is now a very strong and widespread political support, probably simply because at the political level it's now clear that it is highly needed and that the money will not come from somewhere else than financial markets. Public finances are strained and they cannot provide the amount of money that is needed. Bank financing can provide part of it, but not all of it. So where there is room for maneuver is clearly in markets, and that is why the Savings Investment Union, as it is called now, has a chance to work because it is just needed. So maybe to give 3.5 key points in my view, because one of the problems that has been underlined in the reasons why it's not really delivered after 10 years is that maybe there were too many objectives and too many projects. It's not that easy to pick among the many things that must be done, which one must be prioritized. So I will probably give a personal view on that, and other views could be expressed. First of all, a subject that will be probably also tackled by Verena, the organization of supervision. Supervision in the EU, in markets, is not enough integrated. We don't have a single supervisor. ESMA has some supervisory powers, but not enough. And it's why it is important. Well, clearly, supervision do not create markets, but a flawed organization of supervision is an obstacle to the development of integrated markets. It is also a very strong obstacle to another growing objective. That is why I mentioned I have 3.5 points. The first one is supervision, but linked to it is simplification. We hear a lot about simplification. I think I've heard about simplification for 30 years now, and it doesn't work. The reason why it doesn't work in our field is that national supervisors don't trust each other. We are in competition, and since we don't have someone like Verena who is able to tell us all the time what is the correct interpretation of regulations, we make, and the legislators, but also ourselves, we make very, very, very long pieces of legislation, very precise, because we know that if it's not the case, there will be strong divergences in the way it's implemented, creating unlevel playing fields or supervisory competition with a race to the bottom. And that is something that is really happening today. There is a problem with the use of passports where not all regulators have the same interpretation of regulations, and I have to say also not the same reasons to be strict in the way they implement it, because in some cases the products or the financial players are licensed or agreed in a member state where they don't even have any activity. They are active in other member states. And we see that in all the large countries that have a large savings pool, we have a high level of problems, especially in the retail area, stemming from the fact that products are sold on our markets that have been licensed by some colleagues that did not have any skin in the game, to put things bluntly. So the system is dysfunctional, and it prevents development of a real integrated market. It creates a lot of costs, and that is the reason why it's very important, if we want to be able to simplify, that we have. It's basic, it's common sense. You have to have someone who has the last word in terms of interpretation and in terms of what we have to do. And I'm ready to accept that in many cases, Verena, if she's entrusted with enough powers by the legislator, will tell me, okay, you are wrong, you don't have the right interpretation, do differently. So that is the first point, and we will never achieve anything correct in terms of simplification if we don't progress in a more integrated supervision. That is, to me, absolutely obvious. It's also necessary for financial stability, which is the usual term for crisis prevention and preventing crisis to happen in the financial system. Why it is that? Because, for example, for large asset managers in the EU currently, we don't have a consolidated supervision. each national supervisor has a view. We have now set very recently a voluntary college of supervision, but nobody can force their colleagues to do anything. So this is suboptimal, and it's not only suboptimal because for a large asset manager, for example, they still have to report to whatever 10, 5, 6 number of national supervisors, each one having good reasons to require things done that way, that way, that way. But nobody has the last word, and this must change. The two other aspects, and I will be much shorter. We need ways to develop markets. So we need to simplify listing. Listing in the EU, not only in the EU, but also in the EU, is jeopardized by other ways to finance firms. We see a lot of delisting, and what we see arriving on our markets is probably not what we would prefer to see. Many good reasons for that. Private equity has developed a lot. It's the same now in terms of debt. We see arriving a lot of funds specialized in debt, and they play a more and more important role. But it means that the way things are, the way financial markets are functioning are changing a lot. One way to try and foster a new development in capital markets is securitization. I know it might be considered something very dangerous. Be reassured about that. Securitization in the EU will never be the type of bad securitization that caused the great financial crisis. There are many reasons for that. But still, if we want to develop capital markets, and that's one of the points, by the way, that was underlined in ESMA's report, we need, and that is not only for market regulators to look at this, but we need to make sure that we stop curbing securitization and allow it to develop. And finally, we also there's been a lot of work on products. We need to have I don't believe in one product, but some types of products that first will be attractive to investors, and especially for retail investors, because finally we can write all the reports that we like. The investors will choose the type of products that they prefer to invest in. One of the ways to do that is not within our realms, is to look at how taxation is involved in the choice of investors. And we have to make sure that once the EU has decided on the type of products that they want to develop, they also make sure that the taxation is not contrary to these objectives. So all the reports have said what is needed. We need long-term products that will be able to finance European firms. From that point of view, and that will be my conclusion, this is absolutely not what is happening now on the retail markets. What is developing now in the retail markets is ETF, listed funds that are based on worldwide indexes, not European, and certainly not taking into account smaller firms in the EU, and crypto assets. Thank you, Verena. So starting from that, we have to make sure that there is clear advantages and clear incentives given to products that will be more interesting for investors. And that might not be one product or one type of product, but also more interesting to finance the EU economy in the long term. And I will stop with that.
Thank you very much, Mrs. Barbat-Layani. So if I summarize some of the points you have said, we need more central supervision. You say this point. We need more simplification. We need also reforming listing. And we need more securitization. This is one of the points that we also find in Letta and Draghi report and in many other reports. And we need pan-European saving investment products backed with fiscal incentives, because otherwise they do not work. I now pass the floor to Mrs. Rose. Floor is yours.
Yes, and good afternoon, everyone. Thank you very much for having me here. And I am very pleased to follow after Marianne because, in a way, she has already covered the ground amazingly well. So let me try to pick up on a few of the points she made and maybe add a few aspects to that. So first of all, I think on the diagnosis that we have seen, it is about trying to make sure that we actually in Europe have funding sources for companies and that we ultimately deliver investment opportunities for citizens. We have a lot of savings in Europe. We don't have a lot of public money due to the fiscal constraints. So what do we need to try to get our companies able to finance the innovation, the growth that we need to see? We need to develop our capital markets. And at the moment, the capital markets in Europe remain highly fragmented. So just to give you a few examples, if you look at the setup of trading and then the post-trading area, which basically means once you've made a trade, you clear it and you settle it. If you look at the system in Europe, you have at the moment between 300 and 400 trading venues, and you have 14 clearing houses and 32 settlement systems. If you compare that to the US, you have approximately the same number of trading venues, but basically you have two big ones that attract the whole of the listing. That's NASDAQ and the New York Stock Exchange. And then you have basically one clearinghouse and one settlement system. And so it's not surprising that Europe is an expensive and difficult place to actually make trading and action on capital markets happen. The other small fact is, if you look, and this was already mentioned, you basically see that our public markets, so when you actually go on a stock exchange and you raise capital, has been declining, both in terms of new issuers coming to the market. Indeed, quite a few have withdrawn their listing or moved it to the US. Or you also see that actually the trading is not very active in many cases. But beyond the public markets that we all know, la bourse ici, or wherever you are in each country, you basically also need to think about funding that comes from other sources. It really needs to be a whole ecosystem of funding, because particularly for some of the smaller companies and those that are innovative startups, they often are not in a capability to immediately list on a stock exchange. They need to find venture capital, they need to find private funding. At the moment, the only source that they have in Europe is banks. And banks are not always willing or able to provide that risk funding that is needed to really have these small innovative companies to get going. So that's as the analysis. Then a lot of people have written reports recently about this, including ESMA, and I'll come back to that in a second. But if you look at the Draghi letter, and also I think importantly Christian Noyer's report about what the issues are, you see a lot of commonalities on the issues that need to be tackled. Marianne has already highlighted a couple of them: securitization, the simple product. I would add to that something that all three of them mention is the pension system in Europe. We are still, in the vast majority of EU countries, very reliant on basically pay-as-you-go, publicly funded pension systems. We all know these are not going to be able to deliver in the long run, and we need to make sure that actually there are different pillars being developed to also ensure that individuals can look after their old age and invest in their long-term pension. That, however, needs government policy, that needs taxation incentives, and so on. So there's a lot to do around that, which is really more for member state governments. The other point is consolidation of our market infrastructure. I just gave you the figures. With that, we will never be competitive with that fragmentation. And that leads me on to the final point, which is the regulatory and supervisory system. And there, ESMA has been in existence since 2011. Most of the time, what we try to do is make sure that we have more common rules, also in the detail of the rules, that there's more common understanding of how the market should work. That we normally do on the basis of particular mandates which were given by us by the European Parliament and the Council on the proposal of the Commission. It's very similar to the domestic systems where you have the Ministry of Finance or another ministry proposing a law, and then you have the Parliament deciding on it. Within that, ESMA is often given particular mandates to further detail and find compromises that were not able to be found at the legislative level. That leads to a lot of detail, often over complexity, and it's something where we really need, as Europe, to be more agile. Markets develop very fast. If we always rely on doing everything through a legal system, which takes us basically 5 years between the proposal from the Commission and actually implementing the law that has gone through all the processes, that is not fast enough to be able to react to markets and their demands. The second thing is that we need also more agility to deal with particular market situations and potentially be able to alleviate burdens or switch off certain provisions. The other area is supervision, where, as Marianne rightly said, we do a lot to try to drive more common approaches in our supervision, but our tools are quite limited, and it is quite resource and time intensive to actually try to come to common approaches. And so certainly we as ESMA, and that includes all the 27 board members like Marianne who sit around our board, have come to the conclusion that it is important to reconsider in which areas it might make sense to have more EU-level supervision. That means that you basically do not have the mandate at national level anymore. You only have it once at European level. Obviously, that still needs to involve a lot of cooperation with the local experts and so on. But if you had just one decision maker at EU level, you would certainly simplify and create a genuine level playing field, which I think would be very much appreciated in certain areas. In other areas, it's absolutely right that the supervision remains at national and local level. That's where the context of the language, of understanding the domestic society and market system is there, particularly for areas that are closely linked to consumer protection. It's very important that you have that expertise flowing into the supervision. So while I very much appreciate that some people talk about a European SEC, the Securities and Exchange Commission in the US is called the SEC, I think seeing that for ESMA, certainly in our lifetime, is maybe a bit overambitious, but I very firmly believe that in certain areas it makes complete sense to go that extra step. Having said that, I think we need to also continue to break down barriers, make sure that we continue to work together to alleviate some of the burdens and make the system less complex. And for that, we need to work together in the European context. So I'll stop here, but I'm sure we'll come back to some of the issues.
Absolutely.
Thank you.
Thank you very much. So I just note two new issues that you have come to put on the debate. The question of how to finance these risky, innovative startups with this very dominated bank finance system we have. The question of the pension systems, how important it is, but how difficult it is also to advance on that, because it's mainly a national issue. So now I pass the floor to Johannes. What's your take about how to move? That's maybe I will put you a more political question, not so much technical, because we have said already, it's 10 years that we try to integrate the capital markets union. It is different now because we have a more clear purpose that we have. In the past, capital market union, it was mainly about creating more macroeconomic stability for the Eurozone, which is not very appealing as a project. Now we have a clear project that is covering our investment needs. Is this rebranding sufficient to overcome all the political obstacles we have found in the past to integrate these markets? Or we need something else? We need to change the strategy?
No, very grateful to be here. I came yesterday with a train and passed by Notre Dame, and I thought, like, 5 years it only took them to really rebuild the whole cathedral. Maybe that's the spirit that we need to complete Capital Markets Union. I was around 10 years ago at the ECB when the idea and the concept of Capital Markets Union and the action plan was devised. I mean, mind you, that was already a revitalization of a capital markets integration project that preceded Capital Markets Union. And I then, 2 years ago, joined the Jacques Delors Center and now look at it from a think tank perspective in one of the capitals, so in Berlin. So the interplay between the national and the European level, I think, is very important for this project, and it's also the perspective that I try to bring here. I will, first of all, make a positive note, because I was here a year ago on the single market discussion, and where I covered capital markets already, and I struck a very sober note. And I think a year ago, compared to a year ago, we are in a much better place for 3 reasons. The first is, I think the case has been made very strongly. First of all, by Enrico Letta, who's rebranding it as Saving and Investment Union, really showing that we are losing out. Savers are not getting a good return for their savings. Savings are going to the US. The US comes and brings it back to us. So in a way, it's not working for Europe. And we do have huge investment needs where we need to channel it into. And in a way where Draghi comes in very powerfully is really in the quantification. He says, this is the number. And we really need that private money to cover parts of it. The second point, I think, where we are stronger is in terms of ownership and to some extent also leadership. I mean, the Eurogroup has now taken it up, devised the working method in a way to address that. We had even the interplay between the Eurogroup and the leaders in May, where the leaders said not good enough, and then they had to come back in a sort of unique joint effort between Macron and Scholz. They really pushed the Eurogroup to be further ambitious, together with Lagarde from the Governing Council. And to a certain extent, we do have that now sort of ownership by the Eurogroup, very much now supported also by the Commission, that if you look at the guidelines, that very much put this to the individual commissioners to follow up. And the third point, I think you've mentioned that very well, both of you, is that I think we've broken down the Saving and Investment Union to concrete projects. And in that respect, there's sort of more of an agenda and a list of projects. So you will see also when I add my 2 points in terms of concrete projects, that's very much the same hymn sheet in terms of the key focus points. So this is on the positive side. On the not so positive side, I think it's fair to say that we still face obstacles that, despite the very optimistic note that both of you struck, I think we're admittedly still face. The first is really the nature of capital market integration. And the nature of capital market integration means that this is still a very technical term in terms of capture political capital. This is technical, and it also still spans a sort of variety of policy fields, and they're partly related, partly independent. So it's not like in banking union where you have banks as a sort of key actors and a relatively prescribed policy area. It still is a rather wide area. And that also means, and the other dimension is the national dimension. So part of it is European regulation, but a lot of it is national legislation. So taxation, corporate law, even pension system we mentioned. So you, as a consequence of it, you have a lot of actors and very different actors. You have justice ministers, you have social ministers, you have the Capital Markets Association, but also you have CCPs, you have regional stock exchanges. So you have a wide array of different actors involved in it. And of course, many of these actors have vested interest. And that also goes in a way for the member states. Some member states have high stakes, others have not so high stakes. And that means that while the sort of interests are vested and very tangible for the individuals, the benefits for it are much more dispersed, which means that in a way you need the push. So I mentioned that we have in a way the push now much more than before, but what is less the case than in other projects is that there is sort of a crisis. That, like in banking union, where you really had an acute crisis that sort of catalyzed, in a way, going forward. That's been less the case. So yeah, maybe so far. But as I said, the sort of benefits are more spread. So is this notion, which I think Draghi put it well, to say, look, a slow death, a sort of slow loss of competitiveness, sort of opportunity costs that are not tangibly felt, but that are there and amounting. And I think that's part of the problem. And Letta, in his when he presented report, presented well how the sort of the instinct still of national leaders is to say, well, I need to keep control of my national markets. And I hope people from over in Berlin don't mind, but the whole episode around the UniCredit bid versus Commerzbank is been one of it sort of instinctively say, let's preserve my national market. And in particular, the problem in Berlin, if I may, is that they think their market is big enough. So the scale is already there, which of course we know is not really the case. And linked to that is of course the political circumstances that we have in the two sort of the biggest member states, which is France and Germany, which have domestic issues now at hand that are much more prominent than saving and investment unions. This may solve itself in Germany because we have elections, and then a new government will need to position itself on that project. But of course, the sort of leadership that we still sort of saw in April and May is not very potent at the moment. Now, where would I now, as a think tanker, sort of advise? And I think the sort of triple strategy that I would advise is, on the one hand, on the key projects that have been outlined, let's try to really go ahead and let's try to hope that the pressure is sufficient coming also from the industry, so that you have alliances beyond the politics of people pushing, in a way, political actors to make progress. And not necessarily, in my view, the most sort of pressing project, but the project that will make most progress is because of that. It's the securitization. Banks really want it, and therefore politics is sort of making more progress. I'm personally a bit less optimistic than the two of you on supervisory architecture, because there it's interesting that industry is not all enthusiastic. Some are, but we have less of a vocal sort of alliance pushing for it. At least that's my impression. Then brings me to two more elements of my triple strategy. The second one is to get into the national debates. You cannot win debates in the capital, at least not in Berlin, with the term saving and investment union. That is not, I mean, the European dimension on the discussion on where economic policies should go further is not one on European projects alone, at least. So, and of course, one of the key game changer in capital and market integrations is the pensions situation. And Verena, you mentioned it. I mean, Denmark, Sweden, the Netherlands, they have deep capital markets because they really changed their pension systems. And the pressure on the pension systems is, of course, very evident. So in that respect, what is interesting, and I see some elements of a potential development within Germany, and maybe the new government will take it up, because the old government, in a way, had plans and then it failed to reform the pension system or to have a complete debate on how people save for retirements and how the kind of pension system could be relying a bit more on the capital markets. It's probably less the case here in France, but it's certainly in some member states there is a certain degree of opening on that topic. And of course, it's a topic that, on the one hand, as I said, is a game changer because it really brings depth, but it also is closely linked, of course, to social policies, tax issues, which are very much sort of national policy responsibilities. What could Europe add there? I think Europe could add best practices. I mean, we have the sort of pension tracking systems that is best practice in some member states. Draghi end letter suggests auto-enrollment so that you have sort of an automatic sort of enrollment in some occupational pension systems or private pension preparations. So that's one element. And the other thing is that you need to have some sort of minimum standards that you ensure that the strategies are more European, so that you don't cement in a way national investment strategies, but you push them into diversifying a bit more from a European perspective. What we need to avoid though is the PEP experience, if I may. The PEP experience, I don't know how many people have to explain. Yeah, many, not all of you know what the PEP is. It's the Pan-European pensions product. But in a way, it's an example, and you hinted at some of the experiences we had on regulation, of trying to get the best of all worlds. And in a way, with the result that you have only one provider for PEP that is only active in a few markets. So it is sort of fee capped, it has little risk, but in the end, it's very little, I mean, it's not very visible in the national markets, it has different tax treatments, so that's why it's less attractive in some markets than in others. And it really hasn't been able to enter into the able to enter into the national debate. Final point, because I promised you two examples. So the other aspect is to in a way seize opportunities that come from other discussions within Europe for the Saving and Investment Union. And I think the other big discussions that we will have is the discussion on investment instruments, public investment instruments in Europe connected to the multi-annual financial framework that will be sort of starting to be negotiated as of next summer. So the Commission will be coming up with a big proposal on how the financial support instruments will be revamped. One of the key elements of this will be the competitiveness fund. And there, I think, what is interesting to see there is the link between sort of we have the savings is the investment side. So how can you, in a way, attract the investment into a vehicle? And of course, here I would say the model, and thereby I close because we can put the rest in the discussions. But I think the model of the EIB and in particular the EIF is interesting. Sort of trying to attract private savings into guarantee schemes, into equity schemes that would then, in a way, build up and bring the scale, in particular for venture capital, for scale-up capital, and thereby you sort of try to attract some of the money that you have built up in insurance and pension funds into tangible projects. Of course, you need to also look at the regulation, how much it's incentivized in a way to take on more risk for insurance and pension funds. But I think this combination of a debate that we will have anyway on how to use the public money and how it can then be used for the discussion on the Saving Investment Union is useful.
Thank you very much. Just an applause. So we have 1/4 of an hour. Maybe I will move to the public because I think there will be questions. So I see 3 questions already. Ricardo Perisic, Sebastian, and another one. Oh, go ahead.
Mettez bien.
Speak low.
No.
Oui, ok. Ah, super, merci. Eva Gabriel, je suis journaliste pour l'AFP. Est-ce que je peux poser ma question en français? Ce sera plus simple. En vérité, j'en ai 2 petites. Qu'est-ce qui pourrait faire aujourd'hui, concrètement, que l'Union des capitaux pourrait avancer et quelle devrait être, du coup, la prochaine étape, très concrètement? Et une seconde question, dans le contexte français et allemand de crise politique, en tout cas, disons, de complications politiques, est-ce que, à l'inverse, ça risque de ralentir un petit peu l'avancée de ce projet, voire de le mener à une mort lente, comme disait Christine Lagarde il y a quelques semaines, il me semble. Merci.
So just to summarize, next steps, and I recall you that in the later report there were specific proposals for 2025 and 2026, so maybe these are the ones that we can put into place right now, or there are other first next steps to put into place. And then the Franco-German question, to which extent this fragilizes the building.
Yes, thank you. Well, that was extremely interesting. Thank you. You all mentioned fragmentation and the lack of deep, sufficiently liquid markets, etc., etc. When I speak of many members of the business community, particularly those that are interested in new listings or venture capital and that sort of thing, even before considering New York, they think instinctively, they think of London. For them, even post-Brexit, London is still the main European financial center, with centuries of experience, great liquidity, very dynamic, very attractive. Do you think that post-Brexit, and despite the attempts to have a new relationship, we have to accept that the divorce is irrevocable? Or can we still do things to integrate what is, after all, the biggest world financial center in our time zone in our plans for a more effective financial market? Thank you.
Let's take the third question, and then we come back to the floor, to the table. There. No, he wanted to ask about London, I think.
Hi, hopefully you can hear me. Well, firstly, thank you for your interventions. And my question, I mean, it's very linked to what Sir said there, but it's about clearing and the issue of the London Clearing House, obviously. I think it's probably like 80% of trade goes through the London Clearing House, and I know ESMA's trying to roll out new rules and about having more clearing within the EU, but banks have gone against this, and I mean, because of the I was saying before, the UK had the most liquid market. So what's the future of clearing in particular within Europe when banks still want to use London as their clearing hub?
Okay, a lot of interest on London. So who wants to take? Who wants to start?
Shall I start? So as you could probably tell from my accent, I'm actually German, but I lived for a long time in the UK and amongst others worked for the UK regulator and supervisor. At that time it was still called the FSA, now it's the FCA. But nonetheless, I'm now and very firmly for the last 13 years in the European seat, and so have been, I'm very clear that I think we need to look at the European capital markets both as a capital market that is actually strong in its own right, but at the same time open to the rest of the world. And I would there not just concentrate on London, but I believe, increasingly Asian investors are key to actually making sure that we have funding and capital in the EU. The US markets will remain important in the global space. So I think for me, Europe needs to have a capital market that has its own strength, but that attracts also investors and from abroad, because it is important that we remain an open capital market. Only then will it be possible to succeed, in my view. So from that perspective, I believe we need to make sure that the European markets are efficient, that they actually show to foreign investors that there is a single market that they can invest in without a lot of barriers and complications. And that is something which we haven't achieved yet, and which I think is one of the things that is holding us back in attracting some of the overseas capital. And part of that has been and will continue to be also good cooperation with our UK counterparts. I think Marianne and I would certainly say that we have, even through the most difficult Brexit times, when you talk supervisor to supervisor, you need to be able to openly share information. You need to agree on how you are dealing with cross-border players, and that is extremely important, and that needs to be maintained. And clearly we are now also coming into an environment where we will also have more conversations on policy alignment, on common regulatory approaches, and so on. Maybe finally on the UK side, so on the clearing, indeed a lot of the at least the swaps market, which is the interest rate hedging market, is cleared through the London Clearing House in the UK. That has always been seen as a potential risk for the European market, because if from one day to the other, for whatever reason, that is cut off or not available, we in Europe have a problem. And so it has been determined that we need to create an ability to have also clearing in the EU. And with that, there have been a number of policy initiatives which we are now implementing at ESMA to try to bring not all the clearing over to the EU in one go. That's not going to happen, but rather to make sure that there is an alternative, and that actually the players are able to clear here in the EU, and that more and more of the clearing actually gradually moves to the EU. And that is part of a long-term plan. That doesn't mean that we will, have any, we hope we won't have any disruption. We actually have very good relationships with the Bank of England on supervising the clearing systems in the UK. So I think it is something that clearly is important to develop, also to give alternatives, just to be able to actually clear in 2 or 3 different places and not just in one place outside of the EU. And I think maybe just finally on the point of the importance of the political backing, as Johannes also said, for me, being German, living in France, the importance of having strong government support from the German and the French government to that, and commitment to a European solution in all fields of life, but particularly also in the field of financial markets and capital markets, is absolutely key. So I think it is important that there continues to be work in that direction.
Thank you. So I will not repeat what Verena has already said. In terms of quick wins, because it was, I think, the first question. Well, there is really a question on whether we must wait for big decisions or try have small ones that would make things progress. We are ready for both, I would say. In terms of what could advance rapidly, I agree with Johannes. Where there is more push and more traction is probably in the securitization aspect. There are also some possible quick wins in supervision, although it's difficult. One of the aspects that was in the ESMA report and that I think could progress rapidly is the supervision of large crypto asset provider platforms. Unfortunately, the new regulation that would enter into force just this 30th of December has not granted ESMA with supervisory powers, which is absolute nonsense, because these platforms are global. They will be everywhere in the EU. And so it's obvious that it's a new regulatory field, and powers should have been granted to ESMA, maybe not for all the small platforms, and Verena mentioned that there can be different levels of intervention, but for the large global pan-European platforms, that's the case for market infrastructures, but it might be politically more difficult. for crypto asset services providers, it's just nonsense that we all build regulatory and supervisory competencies, while we know that the largest players, and there will be concentration in that field like in any other field, the largest players will be pan-European. So it could be a quick step forward, and there could be some others. There are technical aspects, but if ESMA could be granted no action letters in order to be that could be really working and allow to, Verena mentioned it, waive off legislation that is outdated or not good enough, and not wait for the 5 years that it's changed in some cases. So there could be some quick wins. And obviously, if there is no political traction, nothing will happen, or not much will happen. We will make our best to take care of what is at our level, but most of it is at political level. We need the legislators to act in most areas. So what we can do is also create more supervisory convergence. The tools are not maybe sufficient, and probably in that case, if ESMA could have more powers to force convergence, I think I mentioned that already, it would help. But already on the basis of what we have, we can probably put more focus on it simply and make sure that we do that. So as regards then the subject of fragmentation and the relationship with the UK. These are two completely different subjects. At this stage, unfortunately, because I don't think anybody here requested for the Brexit to happen, and by the way, we lost a lot of time working on the Brexit that we could have dedicated to work on capital market union. So it's very unfortunate, but we had to do it. So from that point of view, it's clear that either there is a new deal with the UK where there is some form of agreement on a new association agreement or something like that. But if there is no such thing, obviously you cannot be a member of the EU internal market without being somehow and strongly linked to the EU and implementing the same rules. If that is not the case, that will not prevent us from keeping on doing what we are doing, which is to keep close ties with our UK colleagues as far as regulators are concerned, especially to work at international level on subjects like financial stability, because, well, obviously financial stability is not a subject that you can solve in one jurisdiction. And by the way, I'm co-chairing with my colleague from the FCA, Nikhil Ratti, the financial stability group in our global market supervisors organization. But obviously, in terms of internal market, where there is a world in internal market which is internal. So obviously, nobody denies that the UK is a large market, but markets are developed also in the EU, and it's really more how the UK sees its future relationship with the EU, because the EU has just moved on. And so we cannot just stop and wait until new political decisions could be taken. The EU has moved on, the EU has developed its markets, the EU is developing its legislation, and in terms of level playing field, the only way to achieve more integration with a country that is now outside of the EU would be for that country to accept to implement EU rules, which I don't see could happen very easily for obvious political reasons. So it's fair to say that it would have been easier to conduct this project with the UK on board, and Sir John Hill was at the origin of the Capital Market Union project. Unfortunately, in the meantime, political decisions happened that we obviously had nothing to do with. And so now we have to continue working with all large markets. Verena mentioned we have relationships with Asian markets, with relationships with the US, which is an even larger market. But I don't see, without a new negotiation on how the relationship could be designed, and in terms especially of rulemaking and rules implementation, I don't really see how we can, in the current setting, have a different relation. It's really close already. So I don't see much room for maybe that there will be a new type of relationship, but so far we don't see any negotiation on the table. So we will wait and see.
Yeah, Johannes, maybe you want to react to
just very briefly on 2 points. So first on clearing, and just to say that I find clearing interesting, less so from the aspect of London, which was already very well covered by both of you, but more for the question of supervisory architecture, because it also shows to you how difficult it is to make progress on supervisory kind of convergence or supervisory institutional reform. I mean, what we did on clearing is that we decided to give ESMA the power for CCPs. But wait, not all CCPs, only CCPs outside the EU. So we have the situation that we have two different regimes. One is for ECCPs outside, where a certain degree of centralization has been accepted. But the moment it came to say, look, but then let's also do this for the, and CCPs, I don't know whether everyone knows what CCPs is. It's sort of the central clearing partner. It's the sort of the counterpart to all traders, and thereby really concentrate, or to all clearers, I should say, and thereby concentrate really risks in a platform. But it's a very well-regulated platform. Net the open contracts. Exactly. So so the decision was not to centralize that supervision at the European level. And it shows to you how difficult it was, because in a way the courage was only for external and not so for the sort of internal players. And also within ESMA, it has sort of a separate structure, it's not completely integrated. So it shows to you that in a way we need to discuss supervisory institutional reform really also in the context of governance reform more broadly. So in that respect, I think some of the proposals that are on the table would also mean that also the structure and the financing of ESMA would be reviewed. I mean, you didn't cover that, but of course, in order to be really a viable supervisor, you probably also really need to go to the contentious issues, and that is governance reforms and the political reluctance that is there, and that the CCP case, I think, shows very nicely. And one last point on the Franco-German relationship. I think I would say that what is interesting is that there have been proposals also from Franco-German players, for example, the Circle of Economic Advisors, that demonstrate that there is a certain degree of convergence. And I mentioned already there will be a new German government where we had an event with Enrico Letta and Friedrich Merz, where Friedrich Merz kind of fostered sort of a competitiveness agenda where saving and investment union played a big role. So let's see whether he will be the chancellor after all, but at least he came with an agenda that seems to resonate on some of the issues we've discussed here. But one thing is very important, I think, to note. We are in a world where, and in particular on this topic, where Franco-German convergence is very important and leadership is very important, but there are also other players. I mean, look, the Spaniards have been putting together a group of member states supporting a particular proposal. The Baltics have been gaining some momentum together. The Dutch, the Swedes are, for obvious reasons we've covered here, because they've deep capital markets. So in a way, we are in a world where there are multiple member states playing a role.
Maybe if I just can add something, one Dutch colleague, what you said reminded me of that, told me we need Franco-German agreement to achieve something in the EU, because the French and the German never agree on anything spontaneously. So once they have agreed on something, you somehow know that this could be agreed by everybody. So
This is the typical recipe of the Franco-German alliance.
No, but I
We'll
think
see.
it is also true what Johannes said. I think we should not forget that we are a Europe of 27.
Of course.
And so actually some of the countries that are not directly in the biggest countries have, and for good reasons, also real things at stake here. How can we access to capital markets? How can we make sure that our small local companies actually get the funding that they need? How can our investors benefit from a wider European? And we need to explain that, because otherwise they will very easily feel that they are completely disregarded and not really taken seriously. So it's very important that we have that 27 member state spirit.
Okay, thank you very much. I have been asked to finish at 6 sharp, so I think we don't have time for new questions, and I think you are all very tired, so you will be happy to end here. So let me thank you, and please applaud the panelists for this panel.